Hello, this is Josh Belk with the Belk on Business podcast. Hope you're having a wonderful day. On today's podcast, we're going to talk a little bit about short-term rentals and the taxation specifically of short-term rentals. As I move into this, first of all, I simply do want to say I'm not rendering specific tax advice to your situation. So please, I strongly do encourage, if you are investing, purchasing short-term rentals, that you do speak to your tax professional. On that point, I do want to point out, make sure your tax professional is someone that's actually licensed, someone who is actually has the necessary experience that relates to real estate taxation, especially if that's the area that you're in. I've seen a lot of, unfortunately, even good, even accounting firms that have put out tax returns that they just did not have real estate experience, and they end up transitioning to us, or we end up reviewing some tax returns, and there can be some serious problems. And I promise you, if you're doing these on your own, or if you're using someone who is either not licensed or doesn't have experience, that you're probably going to make some mistakes here. So I'm not rendering specific tax advice to your situation. For our clients, of course, we have a regular dialogue at the accounting firm that I own in regards to these types of matters. So I am going to do a little bit of a deep dive. I'm not going to go into great depth, but a little bit of a deep dive into real estate taxation as it relates to short-term rentals specifically. Of course, we've seen this particular area of real estate become a lot more popular in recent years. We've seen terms like Airbnb almost become like a verb. I'm Airbnb-ing this property. Okay, of course, they're just a service platform to essentially facilitate the rentals. But so we see Airbnb, VRBO, some of these. There's others out there as well that essentially facilitate the owner of the property, and then the end user, and then it can also provide some services in between and facilitate that. But if you're getting to short-term rentals, hopefully you'll find this particular podcast a little bit helpful, and at least if anything, give you some information so you can have an intelligent conversation with your tax professional. Or maybe as you begin to work through this, to figure out maybe there are some things that you can do within the way that you're operating that short-term rental to be able to maybe take some tax benefit on your own individual return. So generally speaking, we've seen for years kind of the traditional model of renting real estate. And I'm going to focus primarily here on single family. So if you're getting into single family, or maybe a duplex, quadplex, that type of thing, that historically has always been handled as kind of maybe a 1-year lease, a 2-year lease on a property. And so you have an agreement with the tenant. They're going to hopefully pay you on the first of every month, and it's fairly straightforward. Of course, we had a few years ago under President Trump, the Tax Cut and Jobs Act. That allowed for some acceleration of depreciation. So we've seen cost segregations, a lot more of those particular studies being done to take advantage of some of those tax rules that are in place, at least at the moment, and hopefully will remain here over at least the next couple of years. And so, but traditionally, you go and you purchase a short-term rental. You have a tenant that's going to be in that property 1, 2, 3 years, and they pay you every month. The taxation and the rules on that are relatively simple. You get into cost segregation, kind of taking that property, breaking it down into smaller components to take advantage of some accelerated depreciation. It does provide some tax benefit if you are a real estate professional. So now, when a few years ago we ended up with this concept of short-term rentals, the question became, how is this going to be taxed? So is this going to be a type of a situation to where it is considered active? So it's like it's going to be taxed like a short-term storage unit facility. Is it going to be taxed like an active business? Is this going to be taxed like a long-term rental? And so a lot of these particular areas had to be worked through, and of course there was some direction provided by the IRS. Of course, we look at tax law, and essentially this is where we're at as of this point as it relates to the taxation of short-term rentals. So as a general rule, we think of long-term rentals. So when I think about long-term rentals, I'm talking about a property that generally has a lease term of longer than 30 days. And most of the time, these terms of these contracts are 1, 2, or 3-year contracts. And normally, though, when you invest in that type of real estate, it is not subject to self-employment tax, SECA tax. You're not paying kind of that additional tax on that activity. Now, when we're talking short-term rentals, many times that is going to be considered active. And I'm going to get into a little bit into the rules here in just a moment and whether or not this is going to be considered active income. When I say active income, meaning it's going to appear on a Schedule C of your individual tax return. That's if it's a single member LLC, or if you simply hold the property personally, or if we're talking about a partnership. Then as far as taxation, multi-member LLC situation, to where it would appear on page 1 being active, or on Schedule 8825 if it's considered passive on individual return, Schedule C for active, any sort of active type of business activity, versus a Schedule E if it's if you're investing passively. Okay, so active. So what are the active rules as it relates to short-term rentals? First of all, active is a rental period categorically if it's less than 7 days, or if it's less than 30 days, and significant personal services, which I will define here in a few moments. If significant personal services are provided by you or on behalf of the owner of the property, so I'm saying you, meaning if you is the owner of the property, or on behalf of the owner of the property to make the property available for rent. So if you're going through and getting the property available for rent, now there are a couple of areas that aren't included in the personal services side, so I'll get to that in just a moment. So it's considered active if categorically if the rental period is less than 7 days, or if it's less than 30 days, and significant personal services are provided either by you or by somebody that you hire, whether it's an employee or contractor, to go in and get that property ready for rent. We think of short-term rentals. You have people coming in and out between those rental periods. Somebody has to come in and clean. Somebody has to prep that particular property for the next tenant into that property, or the next person that's going to be renting your property. So if it's 7 days or less, or if it's 30 days or less, and those services are being provided by you or somebody you hire, then it is generally going to be considered active. Now, the question is whether or not you have a company that's all they do. So you essentially have like a quote-unquote property manager that you're not hiring as an employee or as a contractor, but generally a third party that kind of does this categorically. You may be able to kind of work around some of these rules and it'd be taxed passively. Okay, so active is rental if it's less than 7 days or less than 30 days and significant personal services are provided. Now, what is the benefit of it being active? So if it's considered active, if you have a loss. Now, of course, we don't get into any sort of business activity, regardless if it's a rental or if it's if you're selling widgets or providing services for someone, for companies. Generally, we go into a business with the motive to make a profit, and the same thing would be true here. However, when it comes to real estate, there are certain advantages that we can take if the activity is considered active. So you might be in a situation to where you can, when you go and you purchase the property, you do a cost segregation in year 1, and you can recognize those excess losses, those tax losses, and offset it against other active income. Now, if you're investing passively in real estate, if you are not a real estate professional, it's going to be capped. You may not be able to take any of those losses. And so there is a great benefit for it to be considered active if you have losses. Now, of course, there are loss rules and that type of thing, and I don't want to get into depth there. But if we're talking about siloing year 1 to where it may really provide an advantage for you to be able to offset against other income. In the alternative, if it's considered active, if you are making money, it is going to be subject to SECA tax, a self-employment tax. So you need to be aware of that as well. So kind of a situation, if you're analyzing, am I going to get into a long-term rental or am I going to purchase a short-term rental? Of course, short-term rentals, we're able generally to generate more revenue, generally speaking, because the rents are higher. We're able to collect more, assuming we can keep that property occupied. So there is a benefit there, but there's also a potential for a downside. Okay, so you kind of have to weigh the positives and the negatives as you're going down this particular road. Of course, there's a lot more headache in regards to if you're doing this yourself, getting that property, managing that property yourself, whether you're going in there, getting the property available between tenants, or if you're hiring somebody to do it, that there is definitely a lot more work involved. So, but there is a tax benefit there if you do have losses. So now there's also going to be a test here for material participation. So if you're going to take these particular losses, if it's considered in a situation to where you're going to want to leverage it, there's going to be some tests here. So you're going to have to take a look and see if there's more than 500 hours during the year of participation in the activity. Now we're talking here about the short-term rentals. If the individual activity and activity on the owner's behalf constitutes substantially all participation in the activity, okay, so if you kind of take a look over the course of the year, okay, I did this for a couple months, but then I had a property management company that I hired to handle the rest. That needs to be considered. And then lastly, more than 100 hours during the year, and an individual's activity is not less than the participation of any other individual. I'm simply going to mention these, and I know if you're listening to this, it's probably a little bit confusing at this point, but I simply just want to make you aware that there are specific rules. We do see situations where clients get into purchasing short-term rentals specifically to be able to leverage, especially on the front end, some of that additional depreciation to help offset other active income and be able to get any money that they paid in back, or simply not to have a income tax exposure at all. But you need to understand that there are rules here that you do need to follow. So personal services, I mentioned I would get to that. So what are the personal services, what are considered personal services that relates to real estate activity? So providing services includes, in this case here with short-term rental, providing any sort of concierge services, hotel-like services, conducting guest tours, providing meals and entertainment for guests that are there, providing transportation, any of those kind of the cleaning between occupants of the property, etc. So if you're doing those hotel-like services for the property or somebody you hire, so you have an employee, you have a contractor, somebody that's in kind of an arm's length of you doing this, that is considered providing services. So otherwise, it is not. Now there are a couple of areas that are not considered services that relates to real estate. Doing repairs and maintenance is not considered services. Why it isn't, I don't know. It's just the way that it's the way that it's written into the code, it's the way it's been interpreted. And then any sort of admin work, such as paying bills, taking care of the books, those types of things, also are not considered services. So it does need to be services as it relates to the occupant and preparation for the occupant. That is not considered repairs and maintenance. And of course, admin is also excluded. So, and I'll kind of go back once again. If it's active, it will be if you make income. If you generate net income from the property, if you generate net income from the property from the activity, then it will be subject to self-employment tax. If it ends up following under the rules of being taxed actively, that is something to where you need to be aware of. You're going to have that self-employment tax. If you have losses, you will be able to offset it against other active income, whether it's W-2 income, other type of business income. And so it is a situation to where you really can take advantage of the tax rules to be able to help be able to generate losses to get some of your tax money back. And then the alternative is also a way, if it is monetizing, if you're managing it well, you're able to get occupants into the property. That's your opportunity to be able to make more money as opposed to a long-term rental property that is there for you as well. So just kind of at a little bit of maybe a higher level, I did get into a little bit of depth here in a couple areas as it relates to short-term rentals and the taxation of short-term rentals. If you have any questions, of course, reach out to your tax professional and maybe kind of dig into this a little bit, see what maybe can be done there to help maybe mitigate some other income that you have there, or if in a situation to where how should the net income that I have from these rentals, what sort of taxation am I going to be exposed to that's going to be a little bit different than if I have a long-term rental. Hopefully this particular podcast brought you some value. This is Josh Belk with Belk on Business Podcast. Have a wonderful day.